Very good afternoon, all of you. Very good afternoon, all of you. Very good afternoon, all of you. Hope you all are doing good. Welcome to Commerce second year class. The last two classes, we were discussing about partnership account, that is admission of a partner. And we did few problems also. And as I said, it is a sure 20 marks question. It's a compulsory question which we have to attempt. Okay. So let us move further. We'll take one more question from the textbook, academy textbook. Page number 242, question number 6. Page number 242, question number 6. Okay. So go through the question, all of you. Vasu and Dasu are partners sharing profit and losses equally. Their balance sheet as on 31st March is given. Liabilities. Okay, what is one thing new here is profit and loss is given on the asset side. Profit and loss is given on the asset side. Then we say that it is showing debit balance. All this while, when we were doing when we are doing admission problems, we have seen profit and loss balance was given on the liability side. If it is on the liability side, we call it as accumulated profit. We call it as accumulated profit, and this is credited. This is credited to all partners in all profit sharing ratio. Okay. Now that it is given on the asset side, it is accumulated loss. It is a accumulated loss. So this has to be debited to all partners in all profit sharing ratio. Right? Very simple. If it is P&L on the liability side, it is credited to partners. If P&L balance is given on the asset side, it is accumulate loss and we have to debit it to all partners. Okay. So here also we meet the same treatment. Okay. Then they decided to admit Mr. Sonu from 1st of April. Sonu has to pay 1,25,000 as capital for 1/4 share in future profits. Sonu should pay 30,000 as goodwill. Machinery is depreciated, building appreciated, provide bad debt 6%. Pass necessary general entries to give effect to the above and give opening balance sheet of Vasu, Dasu and Sonu. Okay. Now, though the question is asking us to write the general entries, but we are not, because it won't be asked in the examination. In the examination, he'll only ask you to prepare the ledger accounts and the opening balance sheet. Okay. So we are following the same pattern. So let us start. So what is the first step we do? What is the first step we do in admission? It is we prepare revaluation account. Okay. We prepare revaluation account. Revaluation of assets and liabilities. Okay. And revaluation account is a nominal account. Revaluation account is a nominal account. All the losses because of revaluation are debited. All the gains because of revaluation are credited. This is particulars amount. Okay. So what is the first adjustment? Machinery is depreciated by 10%. What is the value of machinery given in the balance sheet? It is 50,000. So it is depreciated by 10%. 10% of 50,000 would be 5,000. Then building is appreciated by 20%. Appreciation is again, take it on the credit side by building. It is appreciated at 20%. What is the book value given? 70,000. 70,000, 20% would be 14,000. Okay. Then provide for bad debt at 6%. Provision for bad debt. It is always, it decreases the value of asset. So it is treated as a loss, let us say. So what are the debtors? Debtors are given as 40,000 on that 6%. Provision for bad debt at 6%, it would be 2,400. Okay. Anything else? Nothing is there. So let us close this. Let us close this. 14,000. 14,000. So what is the profit we are arriving at? You see, credit side total 14,400 and debit side total 7,400. So it is 6,600. So what is this 6,600? It is the revaluation. It is the revaluation profit. This revaluation profit is to be distributed between Vasu and Dasu. Vasu and Dasu equally because they are equal partners. So each one would get 3,300, 3,300. Is it clear? Chalo, good. What is the next step? The next step is we prepare cash account. We prepare cash account. Okay. This is both cash as well as bank. Cash as well as bank. Particulars amount, particulars amount. What is the cash balance given? Cash at bank is given as 15,000. So that I'll take here to balance brought down 15,000. Okay. That is the cash balance. To balance brought down 15,000. And when Sonu is admitted, he is bringing 1,25,000 as capital and 30,000 as goodwill. So this is an inflow of cash in the business, no? Business is receiving cash from the capital invested and the goodwill introduced. So let us take it as receipt to Sonu Capital. To Sonu's capital, 1,25,000. Then similarly, goodwill to goodwill, it is 30,000. Right? 1,25,000 capital and 30,000 goodwill. Both are inflows. Both are received. Is there any outflow? No, there is nothing. So let us do the total. What is the total of this? 140, 1,70,000. Okay, 1,70,000. Now the bank balance after this introduction of cash is 1,70,000. Now when we are preparing balance sheet, cash at bank, we will show as 1,70,000. Okay, so this is done. Then we prepare goodwill account. We prepare goodwill account. Remember, whatever treatment of goodwill is there, whatever is the treatment of goodwill, goodwill account, when we are preparing goodwill account, it is always debited with old partners in sacrificing ratio to Vasu to Dasu. What is the amount of goodwill? 30,000. So each one will be credited with 15,000, 15,000. Okay, Vasu will get 15,000 and Dasu will get 15,000. And it is closed. If you see here, cash account is debited with goodwill, no? So when goodwill account is prepared, it will be credited with what? It will be credited with cash. By cash 30,000 and the goodwill account is closed. No balance left. So goodwill will not go to balance sheet. Whatever balances are left, they will appear in the balance sheet. In case of goodwill account, it is closed. So we'll not take it further. Is it clear, all of you? So we prepared revaluation account, cash account, and goodwill account. Okay. Now let us go to partners capital account. How do we prepare capital account? We prepare it in a combined format, no? We prepare partners capital account Who are the partners? Vasu, Dasu, and Sonu, the new partner. Same again. Vasu, Dasu, and Sonu. Clear? If you remember, I told you, normally we get 4 items on the credit side. What are the 4 items? Capital, goodwill, accumulated profits, and revaluation profits. So let us see if we have all these things. Capital, of course, will be there, no? What are the opening capitals? What are the opening capitals of Vasu and Dasu? Vasu's capital is 1,20,000 and Dasu's capital is 1 lakh. So we take on the credit side. Capitals will show credit balance. By balance brought down. Vasu's capital is 120. 1,20,000. Dasu capital is 1 lakh. And Sonu has just now introduced capital to the tune of 1,25,000. Right? So capital is done. Next, what is the second thing we take? We take goodwill. How much goodwill is there? The value of goodwill we have seen, no? Last time, in the last slide, we have credited each one with 15,000, 15,000. So Vasu will get 15,000 and Dasu will get 15,000. Right? Then accumulated profits. We have general reserve. On the liability side, we have general reserve of 20,000. That also has to be distributed in profit sharing ratio, which is equal. So I'm taking it here. Then what do we have? We have revaluation profit. If you remember, we had a profit of 6,600 and each one was credited with 3,300, 3,300. And apart from this, we have another new item that is on the asset side. If you see, P&L balance is given as 5,000. If it is given on the liability side, we do credit it just like general reserve only. If it is given on the liability side, we credit it to partners, but now it is given on the asset side, so we have to debit it to partners. What is the value of P&L? It is 5,000. So it is Dasu will be debited with 2,500 and Vasu and Dasu both will be debited with 2,500 each. Okay. Then what else? Nothing left. All the adjustments are done. So now let us balance it. Let us do the balancing. 120, 135, 145, 1,48,300. 1,48,300 minus 2,500. How much it will be? 1,45,800. This is the closing balance of capital. Similarly, 1 lakh, 115, 125, 1 lakh 28,300. What is the total? 1 lakh 28,300. From that, deduct 2,500. So 1 lakh 25,800. And Sonu's capital, of course, will be as it is 1 lakh 25,000. Okay, so these are the balances we have. By balance brought down 1,45,800. 1,25,000. Balance sheet, you remember? It always has to be prepared in the same sequence as given in the question. Balance sheet of the new firm as on the date of admission. It is 1st April 2000. 1st April 2020. Liabilities amount, assets amount. Okay, so let us follow the same sequence. What is the first item given in balance sheet? It is cash at bank. Cash at bank is given as 15,000, but we are not going to take 15,000 because when we prepared cash account, bank account, we had a balance of 1,70,000. Okay, so we'll take 1,70,000 cash at bank, 1,70,000. Then what is the second thing? Sundry debtors. Sundry debtors, 40,000. Again, we are not going to take 40,000. We are going to deduct provision created on that. How much provision did we create? 6%, I think. 2,400 provision we have created. Deduct that. 37,600. So we are going to take 37,600. Next, we have stock. We have stock. I think there is no change in stock. There is no change in stock. Stock you take as it is. 80,000. Then we have furniture. Again on furniture also there is no change. Take as it is. Furniture is given as 10,000. Take as it is. Next we have machinery. Machinery is depreciated by 10%. So machinery, the given value is 50,000. It was depreciated. It was depreciated at 10%. So deduct 5,000. Deduct 5,000. We have 45,000. Next we have buildings. We have buildings. Building as per the balance sheet is 70,000. But then again, we will not take 70,000 because building was appreciated. Building was appreciated at 20%. That is 14,000. Add 14,000 to 70,000. You'll get 84,000. Next we have P&L debit balance. But P&L debit balance we already have distributed to all partners. Right? So it will not appear in the balance sheet. Now let us see on the liability side. Creditors, no change. Right as it is. Creditors, 20,000 as it is. Outstanding expenses, no change. Right as it is. Outstanding expenses are 10,000. General reserve, we won't write general reserve because we already have credited, we already have distributed it. So now come to the capitals. Vasu, Dasu and Sonu. Vasu's capital now is how much? See our capital accounts. Vasu's capital is 1,45,000, Das 125, and Sonu also 125. So Vasu's capital is 1,45,800. Das capital is 1,25,800, and Sonu's capital is 1,25,000. Okay. So see the total. What will be the total? 170, 37, 207, 287, 297, 330, 330, 4,26,600. We have 4,26,600 here. 125, 250, 350, 395, 396, 406, 4,26,600 here also. Okay. So this is how we completed one question, right? Okay. Let us take one more question. That is question number 7. Question number 7. Here, there is one new adjustment given. There is one new adjustment given. What is that adjustment you see? Goodwill is withdrawn. Goodwill is withdrawn here. Ganesh and Shankar are partners sharing profit and loss in the ratio 3:2. Their balance sheet is given. Okay. In addition information, Balu should bring 75,000 as capital, 40,000 as goodwill. The amount of goodwill is withdrawn from the business by the old partners. Building is appreciated by 20%. Furniture and stock is depreciated by 5%. There is an unrecorded liability in respect of workman compensation. So there are two new adjustments, I should say. Workman compensation is a new liability that is to appear in the books of accounts, and goodwill is withdrawn. All these cases, all the cases what we have done, where goodwill was introduced in cash, but in no case goodwill was withdrawn. But here, in this case, the old partners are withdrawing the goodwill. So let us see how the effect would be. So let us start with revaluation account, as we always do. Revaluation account. Revaluation account. Okay. So, revaluation account, what is the first adjustment? The first adjustment is building is appreciated by 20%. So, appreciation in building is a gain. Take it on the credit side. Buy building. 20% of 1 lakh is 20,000. Next, furniture in stock be depreciated by 5%. Furniture is given as 50,000. 5% of that. 5% of that would be 2,500. Stock is given as 80,000. 5% would be 4,000. Right? Then there is an unrecorded liability in respect of workman compensation. This is a new liability to be taken into consideration. Note, unrecorded liability related to workman compensation is a new liability to appear in the books of account. Okay, so that will tend to increase in liability. So to workman compensation, how much? To workman compensation, 3,000. We have 3,000. Okay, is anything left? No, we have taken all the adjustments. So now let us close this. So 20,000 on the credit side minus 6,595. So we have a profit of 10,500. How much profit? We got a profit of 10,500. This is revaluation profit. And this is distributed among the old partners, Ganesh and Shankar, in the ratio 3:2. Ganesh and Shankar, they will get in the ratio 3:2. So if I distribute it, Ganesh will get 10,500. What is the ratio? 3:2. That is 3/5. 5 twos are 5 ones are. So 6,300 Ganesh will get, and Shankar will get 10,500 into 2/5. That is 4,200. So Ganesh is to be credited with 6,300. Shankar is to be credited with 4,200. Clear? Okay. Now, what is the next step we do? We prepare cash account. Here, you have to pay little attention. Cash account is little different in this case. Why is it different? Because in this case, old partners are withdrawing the goodwill amount. So there will be an outflow of cash from the business. Business में से cash जा रहा. So we have to credit it. Okay. We'll do one thing. We'll do on the next page. I'm preparing cash oblique bank account. Okay. What is the opening cash balance given? See again on the asset side. Cash is given as 40,000. Cash is given as 40,000. So to balance brought down 40,000. Then capital is introduced by the new partner. Balu introduced 75,000 as capital. To Balu's capital, 75,000. And he also introduced goodwill. How much? 40,000 goodwill. Right? And here, both the partners are withdrawing goodwill amount. Whatever amount is credited to them, that much they are withdrawing. So there is an outflow of cash. So first we need to know what is the amount we have credited them, isn't it? We have to see how much goodwill is credited to them. So for that, we have to prepare goodwill account. So I'm doing it here. What am I doing? I'm preparing goodwill account. Okay. In the given question, what is the goodwill amount? Goodwill amount is 40,000. It is to be distributed between Ganesh and Shankar. What ratio? Sacrificing ratio. What it is? 3:2. So how much will Ganesh get? 40,000 into 3/5. 5 ones are 5 eights are. So Ganesh is to be credited with 24,000 and Shankar is to be credited with 16,000. So you see here, to Ganesh, 24,000, to Shankar, 16,000. Right? Now, this much goodwill is credited to them. Okay, see, out of this 40,000 goodwill, that is the total amount of goodwill brought in. And Ganesh, as his share, will get 24,000 and Shankar will get 16,000. And here they are withdrawing that much cash. So by Ganesh, I'll write 24,000, and by Shankar, I will write 16,000. Sir, all these days when we were solving the problems, you never took this on the credit side of cash, because in all the cases what we have done till now, there was this adjustment was not there, that the goodwill amount is withdrawn by the old partners. Okay, in this case, it is given that the goodwill is withdrawn by the old partners. So when they are withdrawing, there is an outflow of cash. So I am taking it on the credit side. Okay, now let us close this. See what is the total here? 40, 41, 80, 1,55,000. 1,55,000. So what will be the closing balance now? Balance carried down. 150 minus 40. It will be 1,15,000. So now, when I am preparing the balance sheet, what will be my cash balance? It will be 1,15,000. Okay, then let us close the goodwill account. Goodwill account debit to old partners as always, and in cash account we have taken to goodwill. Okay, cash to goodwill. So in goodwill account we have to take the corresponding effect. By cash 40,000. Goodwill account is closed. Goodwill account is closed. Okay, just see once. We prepared revaluation account, cash account, goodwill account. Okay. Now we'll go to next step, that is partners capital account. Partners capital account. Okay. So we are preparing it in a columnar format, no? Partners capital account. Debit, credit. Ganesh, Shankar. Who is the new partner? Balu. Ganesh, Shankar and Balu. Ganesh, Shankar, Balu. Okay, what is this column? This is particulars. Okay. Now remember, on the credit side, we get 4 items, right? Whenever we are preparing partners capital account, on the credit side, we get 4 items generally. One is capital, second, goodwill, third, accumulated profits, fourth, revaluation profit. And if it is a loss, we take it on the debit side. So here let us see what are the capitals of Ganesh and Shankar. 150 and 75. So that is the opening capital of Ganesh and Shankar. Ganesh capital is 175. Sorry. It is 150. Ganesh capital is 150. And Shankar's capital is 75. Then Balu has just now introduced capital. How much capital did Balu introduce? Balu introduced 75,000 as his capital. What is the second thing we take? We take goodwill. How much goodwill? It was 24,000 and 16,000. Total was 24, isn't it? Total was 24. Goodwill was total was 40. Total goodwill was 40, and Ganesh share was 24. Shankar share was 16. And in this case, they have withdrawn the goodwill. You see, they have withdrawn the goodwill. So its effect has to be shown in the capital accounts also as cash. To cash, Ganesh withdrew 24,000 and Shankar withdrew 16,000. So that effect, here we are crediting the amount. Okay. And here they are withdrawing it. So we are debiting it. There is an outflow of cash. So we are crediting cash and debiting the partners. Next, we take by accumulated profits. What are the accumulated profits we have? General reserve, P&L balance, like this. Here we have general reserve of 30,000. So that general reserve also should be credited to all partners in all profit sharing ratio. What is the ratio? 3:2. So 30,000 into 3 by 5. If I am distributing general reserve, how it has to be? How it has to be? Ganesh will get 30,000 into 3 by 5. 5 6 it is 18,000. And Shankar will get 30,000 into 2 by 5. 5 6, that is 12,000. Okay, so 18,000 and 12,000. What is the last item? It is revaluation profit. We have prepared revaluation account, no? How much profit we had? We had a profit of 10,500, which was distributed as 6,300 and 4,200. So 6,300 and 4,200. Now let us close this. Okay. See what is the total on the credit side? 150, 174, 184, 192, 1,98,300. 150, 174, 184, 192, 198, 300. So 198, 300 minus 24 to balance carried on. It will be 1,74,300. 1,74,300. Similarly, Shankar 75, 16 is 91, 101, 103, 107, 200. 107, 200 minus 16,000. It would be 91,200. For Shankar, it will be 75,000 as it is. So what are the opening balances we have to write? By balance brought down 1,74,300, 91,200 and 75. Okay. See this. Next step, we'll go to balance sheet. Okay. Balance sheet, as I always say, is to be prepared in the same sequence as given in the question. As on 1st April 2020. These are our assets and these are the liabilities. Asset, what is the first item? Cash, 40,000. Shall I write 40,000? Sir, no. We have to take the balance from cash account that we have prepaid. We have prepaid cash account and our balance is 1,15,000. So I have to take 1,15,000. Next, bills receivable. There is no change. So let us take bills receivable as it is. So what is the value of bills receivable given? 45,000. 45,000. Then we have sundry debtors. We have sundry debtors. What is the value? 90,000. There is no change on this also. So let us write as it is. 90,000 as it is. Then we have stock. We have stock. Stock is depreciated by 5%. So stock is given as 80,000 and it is revalued. It is revalued at 5%. So 5% would be 4,000. Now the stack value would be 76,000. 80 minus 4, 76. Furniture is given as 50. Furniture is given as 50. Furniture is also depreciated at 10%. So 45,000. Next is buildings. Buildings are appreciated by 20%. Buildings 1 lakh. Okay, buildings 1 lakh. They are appreciated by 20%. So add 20%. And we have to take 1,20,000. Done with the assets. Now liabilities. What is the first item? Sundry creditors. Sundry creditors. How much? Sundry creditors is given as 50,000. Sundry creditors is given as 50,000. Bills payable 60,000. No change. Bills payable 60,000. No change. Then we have bank loan. Bank loan. Bank loan is given as 40. There is no change. Then we have capitals. We have capitals. General reserve is also there, but you are familiar now, no? General reserve, once distributed, again will not appear in the new balance sheet. So what are the capitals? Capitals of Ganesh, Shankar, and Balu. We have prepared their ledger accounts. See what are the balances? 174,300, 1,74,300, 91,200, and Balu's capital was how much? 75. Balu's capital was 75. Apart from this, there is one more liability which we have to record. If you remember, when we prepared revaluation account, we have taken one unrecorded liability, no? We have taken one liability into consideration, which is to be appear in the books of accounts. I made you write here, you see, a new liability to appear in the books of account. That is workman compensation. So this we have to show in our balance sheet on the liability side as workman compensation. Okay, so anyways, I'm writing it here. Workman compensation payable. Workman compensation payable. It is 3,000. Okay, actually it should come here, but no issues. So what is the total you see? 50, 60, 150, 150, 250, 324, 325, 325, 426, 426, 4 lakh, 150. Let us do the total here. 1,50,000, 1,74,300, 91,200. Okay. Then 75, that is 78,531. 4,93,500 is the total. 4,93,500. This is the total. Check once. Okay. Now, I think we have done quite a good number of problems in admission and treatment of goodwill. There is one more method which is called as, for treatment of goodwill I am talking about, where goodwill is not brought in cash. Let us get to know that method. There is another method. What was, if you remember, the first day I told you, when the goodwill is brought in cash. Second was when the goodwill is brought in cash and withdrawn. And the third method is when the goodwill is raised or created. So we'll see this method. When the goodwill is valued, or he may give the word raised or created. More popularly, he'll give goodwill valued at. So what does this mean? Of course, valuation they do have to do, but here it is said that when the new partner does not want to introduce goodwill amount in cash, he will bring only capital, but he is not in a position, or whatever reason it is, that he is not introducing goodwill in the form of cash. So what is the treatment? Right? See, normally all the cases what we have done, we were receiving two things. When the new partner was admitted, he was getting capital, so cash to capital, and he was introducing goodwill. So cash account debit to goodwill, we were writing like this. But in this case, goodwill is not brought in cash, so we won't have to write the entry cash account debit to goodwill account. But always it has to be credited to all partners. So when the goodwill is valued or raised or created, we have only one general entry, that is goodwill account debit to all partners capital account. Goodwill account debit to all partners capital account. Right? And here, in this case, goodwill account will show debit balance. Goodwill account will show debit balance. That is, goodwill account will not get closed. If you see the last case or any of the cases what we have done, when we were preparing goodwill account, if you see here, goodwill account was not showing any balance. Debit side, credit side, total, they were same. So goodwill account was getting closed. There was no balance left in goodwill account. That is why we were not showing it in the balance sheet. If any balance is there, like you see in case of cash, it was showing a debit balance of 1,15,000. So we were taking this cash on the asset side. So if any item shows a debit balance, it will appear on the asset side of balance sheet. And if any item shows a credit balance, it will appear on the liability side. Like here, capital accounts were showing credit balance. So these balances we are taking on the liability side. So while closing the books of account, if any account shows a debit balance, that will appear on the asset side, and if it shows credit balance, it will appear on the liability side. Okay. So now in this method, when the goodwill is created, when the goodwill is valued, we have to pass only one general entry, that is goodwill account debit to all partners account. And since there is a balance left in this, goodwill amount will appear, goodwill account will appear in balance sheet. Okay, please pay attention. This is for IP. This is how we teach. When goodwill is created, goodwill account shows a debit balance and goodwill has to appear in the balance sheet. Okay. But then, okay. So next one is, shall we take one question on this? There is one more method. I'll take that method also. So what was this method? When the goodwill is valued or raised or created. So we write goodwill account debit to all partners capital account and goodwill account will appear in balance sheet. All these while we were doing problems when goodwill was not shown in balance sheet because goodwill account was getting closed. Here, goodwill will show debit balance. As such, it will have to be shown on which side? On the asset side of the balance sheet. Okay. I think we are running out of time. So I'll conclude the class here. Tomorrow we'll continue the same time and we'll get to learn more about this new method when the goodwill is created or valued or raised. Okay. So please do prepare, go through the class, what we have done today. You go through, you see all the problem solutions. Okay. Don't waste time. Take care. God bless you all. Bye.